All right, 12 o'clock. Let's get started. Hello, everybody, and welcome to our Simon Quick's webinar on a hotly discussed topic that we've seen over the past couple months. My name is Tom Morr, and I will be your host today. And the topic is breaking down President Biden's and his administration's proposed tax changes. On our side, talking to clients, prospects, CPAs, estate attorneys, we've seen this topic come up, and right now we're still in the proposed stage, but we thought it would be a great opportunity to get our networks involved and get a guest in, Michael, who I'll get to in a second, but really to give our insights into what's been proposed, what hasn't been proposed, and what, more importantly, we can do about it leading into the end of the year. So before we jump into it, I'd just like to read a quick disclaimer so I don't get in trouble. The presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. Luckily, we're not talking about any investment strategies. We're strictly speaking about tax, so we don't have to worry about that. There is a Q&A feature on the chat. If you have a question, please type it in. We're trying to keep this webinar to 45 minutes, so we may not get to every question today, but please reach out to your contact at either Simon Quick or Meisel, Tuteur, and Lewis to ask that question offline, and we'd be happy to help out. Another thing, the webinar is being recorded and will be circulated over email tomorrow. So if for whatever reason you have a lunch and you have to jump off, we will be sending out a recording of the webinar tomorrow. So as I mentioned, my name is Tom Morr. I am the head of client advisory here at Simon Quick. I am also one of our 10 client advisors who works directly with clients. And really our goal is to be proactive, and with this ever-changing financial landscape, try to guide our clients through making the best decisions for themselves and for their families. And more importantly, I'm joined by Michael Lewis today, great guest, and he is a managing partner at his firm Meisel, Tuteur, and Lewis, and really has grown the firm since its inception, and his role has evolved over the years to really providing that guidance and financial advice on business and personal issues, from finance to accounting to preserving family wealth. And he's a graduate of the University of Vermont and has served on the board of its business school, and really has been a great friend to the Simon Quick firm. And we're lucky to have him. So Michael, welcome, and thanks for joining us today.
Thank you, Tom. Pleasure to be here.
Yeah, so you and I have spent some time prepping for this call, and it's a little bit of a different type of call because the comments on this call and what we're going to go through is all hypothetical, right? It's all proposals, as nothing's been implemented. So hopefully we get a little bit of a pass with people because we don't have a crystal ball.
That's true. Hopefully when this whole thing is done, okay, at some point we'll find out exactly what's going to go into law.
Exactly, and I think it sets it up perfectly for a part two. So if something does then get implemented into law, we'll have more concrete and real examples for people to take home with. But for now, we're just talking about hypotheticals, as there's really no consensus among lawmakers.
Correct.
So just a quick overview of the timeline and where we are today. So earlier this year, after the election and after President Biden took office, there was a releasing of two major spending plans, the American Jobs Plan and the American Families Plan. The Jobs Plan was really focused on major investments in both traditional infrastructure and green technology, really to make America more competitive in the global economy. The second piece, which is the family plan, was more focused on universal pre-K, 2 years of free community college, and heavily subsidizing childcare for middle-class families, along with expanded child tax credits. And once those plans were released, I think the common thought when people went through them was, great, but $5 trillion estimated over the next 10 years of added spending. How are we going to pay for this? And what is going to be the plan on how the country affords this, in addition to the spending that we already have? So on May 28th, the administration released its plan for revenue increases, and that came at the release of the 2022 budget. Along with the budget came a 114-page book called the Green Book. And Michael, can you just touch on, a lot of people aren't familiar with the term, they're familiar with the movie, they're not familiar with the term, but what is the Green Book and why is it important and why are we going to talk about it today?
So the Green Book basically is the proposed tax legislation. It talks about what the existing law is versus what the proposals are. Okay. It also discusses the rationale for why they want to do these increases. Okay. And that's basically it. It's basically from the Biden administration. It's what they're presenting to Congress.
Great. And the way we are going to present today is going to be, and I'll go into the next slide, is first and foremost, the key items that made its way into the Green Book. There was a lot of talks about proposals that were issued, and some made them into the Green Book and some did not. Now, again, the Green Book does not guarantee what will become law. It's more of a starting point for Congress to make decisions. Some things may stay there, some may be pulled out, some may change along the way, but it's really creating a roadmap for where the administration would like to lead Congress. And so along with that, other items were left out of it. And that doesn't mean that those items are never going to be brought up again. They are just not in the initial release of the Green Book. So starting with, I think, the most common form of tax and the changes along that is ordinary income tax. So ordinary income tax is really the tax rate that you get from your paycheck. It's a progressive tax, which means you pay a higher rate the more money you make. Pretty simple changes, I would say, Michael, in the Green Book, but can you just walk through
basically what they're proposing is lowering the exemption amount. So, and raising the rate on that top tier from 37% to 39.6. So if you take a look, right now for married filing joint returns, the threshold is 628.3 for the highest rate, and they're proposing it goes down to 509.3. So in addition to the rate going up, okay, that $100 and some odd thousand of exemption lowering would also increase the rate by 0.5%, 2.6.
Right, and that fits into the administration's plan of not raising taxes for families that make less than 400,000. I would say that the threshold being lowered to that 500,000 mark and the rate increasing. So you pay a higher rate at a lower threshold with these proposed changes.
Correct.
Now, the other key point here is that the proposal said it would be effective starting next year. So some time for people to plan and maybe get ahead of it, but January 1, 2022 for taxes that will then get paid in 2023. So a little bit of time. I think that this was an obvious one that people figured, right, Michael, that they were going to change, or at least the upper point. We were at 39.6 before the 2018 tax cuts. So one that was easy for the Biden administration to throw in there, right?
Right, and correct. If people want to try to plan, okay, maybe they accelerate income into this year, into 21, maybe postpone deductions until next year. But it's not that significant, really.
Right. And as I mentioned, we've already had it 3 years ago or 4 years ago.
Correct.
The next tax, which I think has a bigger impact and is more of a change, is the long-term capital gains tax. And just to set the stage on long-term capital gains and what they are. So long-term capital gains tax is a voluntary tax. And that's important because we'll get to that in a second. But it's a voluntary tax that is paid when a taxpayer has either the need or the desire to sell a capital asset. So what does that mean? If you have an asset that appreciates in value and is held over longer than a year, when you sell that asset, currently you get preferential tax treatment. And Michael will get into what that is and what that's going to be. But right now, that's based on your need or desire to sell that asset. And you get a better tax rate than what we saw in the previous slide in ordinary income. Now, the administration argues that that benefits the investment class, and the people who drive primary their earnings or on investments will benefit, and that's more likely to be the more wealthy in this country, where the working class will pay higher rates on the other side. So it was pretty much known that the administration was going to go at, or at least attempt to go at, this type of tax. So Michael, where are we today, and what did they come up with, and what is at least the initial proposal here?
Right. So right now, long-term capital gains are taxed at 20% plus 3.8%, which is the Obamacare tax. Okay, so it's a total of 23.8 plus whatever state taxes there are. What they're planning on doing is for if your adjusted gross income is over $1 million, okay, they're planning on taxing the long-term capital gains at the 39.6 plus the 3.8, which comes to 43.4%. So it's quite a big difference.
That's a big change. So basically, say the ordinary income rate does increase from 37% to 39.6. Anybody that's making over $1 million in adjusted gross income would find themselves in that top tier rate anyway, which is 39.6, or would be 39.6. And then tacking on the 3.8 gets you to that 43.5%, right?
Correct. So if somebody, let's say, had $1.1 million of income, of which 200,000 were capital gains next year, okay, or whenever this takes effect, basically $100,000 of those capital gains would be taxed at the higher rate, and 100,000 at the long-term capital gain rate of the old 20%.
Right, and as you said, that is a big jump, obviously, and it's going to cause investors to take a pause when selling the asset, because especially, and I know a lot of people on this call today are from the New York, New Jersey, maybe California area that has a state tax added on top of it that sometimes ranges from 7 to 10%. So you're looking at over 50% in tax, where just before it was around 30%, right?
Right. And what some people are doing already is they're selling off assets now, okay? And the only problem with that is there has been some talk about this long-term capital gains taking effect retroactive to April 28th. Whether that'll happen or not, we don't know.
Yeah, that was you're reading my mind, but that is something that has definitely been discussed. And one of the questions that I've been receiving that I'm curious on your thoughts is, the ordinary income makes sense, start on January 1, 2022. Why even propose going backwards on the capital gain side?
I think that just for this one reason, that possibly they're worried that people are going to go up and sell a lot of these assets in anticipation of the law of the tax rate going up in 22. Okay, so they're trying to prevent that, from happening.
Right, because one of the strategies here would be, if I know that the rates are going to increase next year and I would like to, sell the asset, I would rather do it this year than
Correct.
Next year, and that could cause a exodus from capital assets.
Right, and who knows what would happen to the stock market too.
Right.
All of a sudden, everything was getting sold.
Yep. And qualified dividends is included in this as well. Can you just touch on that, because that is preferential treatment as well?
Right, because right now, qualified dividends, which are dividends basically in, corporations. Right now they get taxed at capital gains rates, and that would also go away and be taxed at the higher rate.
Right. So looking at this, and again, the extreme jump, right? It's almost like we're looking at both ends of the spectrum here. We have where we are today, which is the 20% plus the net investment income tax, and then what's proposed being the 39.6 plus the 3.8. Is there possibility of meeting in the middle, call it 25%, 28%, where there's an increase, but it doesn't go to the extent of ordinary income?
I believe that would probably happen. I think there will be a compromise, but don't quote me on it.
Okay.
There has been all types of talk, going 25%, 28%. So hopefully, it will be somewhere in the middle.
Right. And we definitely made that disclaimer that we're not holding anybody to anything today. But again, just seeing this play out, as I mentioned, there will be serious thought and consideration now, if this were to take place, about selling assets, and which, again, doesn't do much for the government in terms of revenue, because if you're less likely to sell an asset, then there's less likely to be a tax on it. You would just hold until completion. And that really leads me into our next topic, which probably hasn't hit the news or the newspapers or been discussed about enough, and is one of the more aggressive proposals in the Green Book. And that is the characterization of transfers of appreciated property. So right now, and then Michael, I'll let you go into the proposal, but currently, when one transfers appreciated property, if they do it during their life, if I give Michael $100 worth of Apple stock that I paid $10 for, he would assume that Apple stock with the $10 basis. Now, if I passed away and in death, I moved Apple stock to the next generation, then there would be what's called a step up in basis, which I'm sure many people on the call have heard before. What that means is that my descendants or whoever I pass that stock to would inherit that Apple stock, the $100 worth of Apple stock, at a $100 cost basis, therefore not owing any tax on it. And this was a strategy for a long time, which is basically let your capital assets appreciate, borrow potentially against them at low rates, as we know there's very low rates in the world, and then hold them until you die to receive that step up in basis, so no capital gains taxes ever have to be realized. So the administration saw potentially raising capital gains would then cause people to hold on to assets more longer and until death. So they wanted to put something in place that would be able to avoid that, and again, raise revenue, raise more money to support the spending. And that's where this new change in this proposal comes into play, so that there will be no escape, whether you sell an asset, transfer, gift an asset, or at death. There's really no escape. So Michael, why don't you touch on the good news here?
So basically what would happen is that if you transfer assets as a gift during your lifetime, okay, there would be capital gains tax at the time you transfer, okay? And there would be a $1 million exemption, okay, per person, so that the first $1 million of gifts that you give away you won't have to recognize the capital gain, but everything over that, okay, you have to pay the capital gains tax at the time you transfer it, which is really, and then at death, what happens is that your estate would then pay a capital gains tax on the unappreciated value, okay, and then, or the appreciated value, and then in addition to that, there would be an estate tax, okay, based upon the gross value of the estate. So you're really having, so no longer could you pass along assets, get a step up in basis without paying the capital gains tax. That makes
Right.
sense?
So yeah. So let's break that down a little bit, because I think this is really important. So
Right.
in my example, that $10 I paid for Apple stock that is now worth $100. If I were to give that to you in our life, even though that asset isn't sold, it would be treated as a taxable event, and that $90 would have to be realized as a capital gain.
That's correct.
That's
That's
pretty.
that's a big item.
That's a
Yeah.
big item. And to your point about at death, the same thing would apply. So that $100 worth of Apple stock would get passed down, but instead of it being inherited at $100 with $100 cost basis, it would be inherited with $100 cost basis, but that $90 capital gains tax, assuming the exemption, that $1 million exemption, which is not a whole lot over a lifetime, is used up, capital gains tax would come into play there. And I think we'll get into this, but it's also important to know that this is a separate tax from the estate and gift tax, which right now the exemption is 23.4% for married filing jointly. This is a tax on appreciated property.
That's correct. And to your point, as far as, I don't know if I'm jumping ahead, but they haven't been talking about lowering the exemption if this takes place.
Right. So they threw a small bone there, even though that this is probably much more powerful and really, as I mentioned before, takes that capital gains tax from voluntary to now involuntary in some states, because you're forced to basically realize the gain, whether you like it or not, on gifts or at death. Now, as you mentioned, you touched on this, Michael, there are some exemptions that come into play here. I'll list them out if you just want to comment on it here, where gain would not be realized.
Right. So spousal transfers, gifts to charity, and personal and household items, in addition to the $1 million gain per person, and also the $250,000 on sale of personal residence.
Right. So again, all of these, especially spousal and charity, that's already been in play. It's not earth shocking. There's a couple other ones, grantor trusts, which is basically the same tax idea as the individual, wouldn't count, but everything else would fall into play here. So again, really changing the landscape and changing the planning that could potentially go in. Now, as we mentioned, this is more on the aggressive side of the proposal, and whether or not this gets implemented is still to be seen. But we wanted to at least let our audience know what is being floated out there right now, because it isn't being talked about as much as just the rates increasing hit the news.
Right. This would be really egregious, and they may end up compromising and just lowering the exemption from the 23.4 million down to maybe $10 million, $5 million apiece.
Right.
They've talked about $3.5 million each. So maybe that will be the compromise, but I just can't understand how this would,
Right. So 114 pages, there are a lot of other things in that. It wasn't just what we covered today, although we tried to focus on what our audience might be more interested in. But I'll just list these out, and then Michael, you can comment. But a couple of the other items that were in there were carried interest being treated as ordinary income, non-corporate trusts and partnerships that have held assets over 90 years. That would be a taxable event then. And then a popular one, the corporate, or at least one that's known by most people, the corporate tax rate increasing from 21% to 28%.
Right. So carried interest, it mostly involves hedge funds. But if somebody gets a carried interest right now, the income that they derive from it is taxed at capital gains rates. They're talking about that being treated as ordinary income. So I have a feeling all the hedge funds would be, their lobbying groups will be out there right now.
Yeah, I bet.
The corporate tax rate going from 21 to 28, there's already talk about, instead of 28 being 25%.
Yep.
So we don't know where that's going to end up. And the non-corporate trusts and partnerships, this one, I don't know where they threw this from, but this would be if you have assets that are in a non-corporate trust and a partnership that have been held 90 years, they're talking about immediate taxation on that.
Right.
So,
Great. Well, next, we covered at least the main points of what was in the Green Book, but now what was not in the Green Book. So during the lead up to the election, and then the president's first year, a lot of ideas have been tossed around. And like I said, some made it in and some didn't. And I would say that failing to be listed in the Green Book does not necessarily mean that the proposal's been dropped. Maybe they weren't focused on that particular reform. Maybe they didn't think it would raise enough revenue to really worry about putting it in there. But some of the discussion, and Michael, you touched on a couple before, were excluded from the Green Book, maybe permanently, but again, still to be seen whether or not that gets included in some other form or proposal. So just to mention a couple of the more popular ones, on the estate and gift tax side, and this is what you brought up, really the exemption amount and the tax rate.
right, because right now, the exemption amount is 23 point something for married filing jointly. Tax rate top is 40% right now. They haven't talked about that, but remember, as Tom said, this is the Biden administration. It's their proposals to Congress. Congress could go ahead and do something totally different.
Right, exactly. I think they might have said, look, the step up in basis, that's a big change. So we'll keep the exemption amount for married filing jointly at 23.4. That's set to sunset anyway in 2026, back to the Obama levels. So maybe they said, hey, it's going down anyway eventually. Let's focus on this step up. And again, like you said, that 40% tax rate over the exemption, that was talked about moving up to 50%, even 60% in some cases. But as of now, it's staying at 40%.
Correct.
The other thing that was discussed was the full or partial reinstatement of the SALT deduction. And the SALT deduction is state and local income tax. And before the 2018 tax cuts, taxpayers were able to deduct taxes paid to their state on the federal side. So people who lived and were high earners in high tax states were able to take significant deductions based on their state tax that they paid. In 2018, this was then limited to $10,000. So again, a small limitation relative to what people had been taking in terms of deductions in the past on the state level. So with such a tight margin in Congress, it was floated around that there would potentially be a reinstatement in order to get the lawmakers from New York, New Jersey, California, any of these high tax states to be on board with reform. We didn't see this anywhere in the Green Book, so it was not discussed. And any reason you think that was left out there, I would have thought, Michael, that they would have included it to try to get more people on their side when trying to pass these proposals.
I don't know why, but there have been a lot of members of Congress that said they will not sign any bill. Democrats too will not sign any bill unless it includes the reinstatement of the SALT deduction. And there's been all types of talk that reinstatement of the SALT deduction will at least lessen the blow. It'll lessen the blow of these other tax increases that are coming in. Because it's substantial between state and local income taxes and real estate taxes. People lost out on hundreds of thousands of dollars in deductions.
Right. And I read somewhere that the estimated cost was about $80 billion over 10 years. And again, perhaps people in the Biden administration saw who it would help and predominantly help the people that pay the highest state tax in those areas, and wanted to move away from that at that point. It will be interested to see if they have some form of it come back. Again, that $400,000 of income seems to be a number that they're focusing on. So perhaps they included for earners who make less than $400,000 but pay more than $10,000 in state tax. That's something that we could see down the road. But
that also would not help the high earners.
No, exactly. That would throw them off. So that might be somewhere they end up. But that, I think you and I both agree that wouldn't stop people from moving out of these states into low state tax states. So, but there have been ideas floated around, and actually the IRS has approved some actual workarounds for this. Do you want to touch on that briefly, Michael?
Well, basically, I know in New Jersey, and I think New York too, there's some type of abate tax where you can pay the state taxes at the entity level on behalf of partners in an S Corp and LLC and get the deduction that way. So there have been some, workarounds on the state and local income taxes, but a lot of people aren't in that position where, they are partners, in a partnership. So they're like, they're sort of out of luck right now.
Right.
So.
Right. Yeah. It helps some people, but again, I think the majority are still out of luck here. A couple of the other items that did not make it into the green book that were floated around, removing the 20% deduction from pass-through entity income. Qualified opportunity zones was something that was put in place in 2018, that there was a little bit of concern that benefit was going to be removed going forward. That wasn't in the green book. Capping the 401k tax deduction. Basically, anybody who makes over a certain amount of money would have the amount that they can put into retirement capped. That wasn't in there. And then the wealth tax, which I think there are definitely a couple senators who continue to go back to the wealth tax, but that wasn't in there as well. So again, not saying that these will not make it into a future proposal, but for this proposal, at first, these were not in there.
Right. And I don't know if they will.
Yep. Right. So Q&A, we kept it high level. We kept to the points that we think would really impact our clients and friends of our firms. And so if you have a question, please type the question in. Like I said, we'll try to get to everyone, but we do want to keep this at around 45 minutes, give or take 5 minutes. But really, I want to start out with a question that has come in across the board, right? Almost every conversation we have when we're discussing these proposals. And that is, with all these changes that we discussed, some that we have not discussed, are there specific decisions that you would advise clients to proactively make right now? Whether that be relating to ordinary income, capital gains tax, estate tax, gift tax, whatever it may be. Is there anything you do now, knowing that we don't have a crystal ball and we do not know what is actually going to be put in place? So Michael, I'll let you answer this question first, and then I have some ideas on my end, unless you cover them all.
So as far as planning is concerned, it's very, very difficult, as Tom said. This whole thing with capital gains, we have clients that are rushing to sell off assets, they're rushing to sell off real estate, all right? Now, if the law becomes retroactive, then really what they've done is maybe they've sold off assets that they wouldn't have normally sold off, to try to avoid the capital gains, and, the increase in the capital gains. And so it may have gone for naught. So I don't know what to advise people really on that. I think people have to just stay flexible right now. One thing we didn't talk about too, I just remembered, were 1031 exchanges.
Right. That was one of my questions. So
right, because
do you want to touch on that real quick?
Yeah, I'll touch on that. So right now they're talking about on 1031s limiting the amount that can be rolled over, through a 1031 to $500,000 per individual, or $1 million if you're married filing jointly. So a lot of people are rushing now because they're talking about being effective for calendar year 22.
Right.
So people are looking to do 1031s now, which might be smart. Hopefully that won't be retroactive. There hasn't been talk of it being retroactive, but once again, it's very hard to plan right now. I've seen clients doing estate planning now, understanding that, if they're going ahead and gifting, if the exemption amount is lowered, okay, from the 23.4 million down, okay, they may have gifted stuff for naught. So what some people are doing is they are drafting documents and basically, and I know we took a waiver here, but people are holding documents,
Right.
Until they see what happens.
Yeah, I think, from my perspective, you hit the nail on the head when you use the word flexibility. And I think it's knowing what is out there and being proposed, but not necessarily rushing to make immediate changes without concrete information on file that we can then act off of. So I think from our end, what we're doing is we're advising clients first, work with your advisor to analyze your situation. And most important, it needs to make sense for you and your family, right? You wouldn't want to rush to do something if it doesn't make sense in your overall financial plan. So first, look at everything and try to align yourself with your goals and objectives and what you're trying to accomplish. And I would say on the ordinary income side, you touched on this earlier, Michael, it is pushing income into proposed lower tax years and pushing deductions into higher tax years. So if we think there's probably a pretty good chance that ordinary income rates are higher at the top end in 2022 than 2021, it may make sense, if possible, to push some income into this year. And maybe you hold off on your year-end charitable deduction until next year to get more of a benefit at a higher rate. So that's one of the things that we're talking about. And then on the gifts and transfers, as you mentioned, some people are already planning that. We know that 23.4 is set to sunset in 2026. And if it fits into a client's plan, we are talking to them about seriously considering moving assets out of their estate right now and taking advantage of the large exemption and the fact that there's no, right now, capital gains on appreciated assets. So really looking at the plan, seeing what they want to do in terms of next generation planning, charitable planning, and having the conversation and identifying assets or strategies in case things change, and then being able to act on that. So I would suggest, we're in the summer right now, things might be a little slower. Trust and estate attorneys are going to get busy at the end of the year, but I would advise people to start thinking about these topics now, even if there aren't any action items right now in the summer.
I agree.
Next question that came in is, Michael, I'll let you touch on this. What is your view on long-term loss carry forwards? And I think this comes from, obviously, if the rates go higher, losses are going to be more valuable. So will they be worth more if / when the changes go into effect?
They should be. They should be, unless Congress says something about limiting the loss carry forwards. But in logic, if the rate goes up in 2022 and it's not right, then they should be worth a lot more.
Yeah. And, I think as we look through client portfolios, and look, I guess this is a good thing, right? There's not a whole lot of losses around. Markets have been able to go up. Right. We're able to take losses during the sell-off last March, but now we have portfolios with a lot of gains in them. So, again, the market could be volatile as we go into year end or the first quarter, but those losses, it's even more important to keep your eyes peeled for any losses to take advantage, because you're going to want to offset the gains that come in naturally through this increase in the long-term capital gains rate.
Correct.
The other thing I'll just mention quick is that, we spend a lot of time on taxes, on trust and estate side, but insurance is another component that I think people will look at differently maybe if this tax on appreciated assets comes into play. Having liquidity at the end of your life to be able to pay those taxes is going to be increasingly important if that proposal goes through, and potentially people not wanting to have to liquidate an illiquid asset, sell at a discount, but have that liquidity coming from a life insurance policy. So, we've heard murmurs about that and that becoming more important, but it's something to consider as well. Any idea on when things might be enacted? I know that's a tough question, Michael. You and I started prepping for this sometime in June, and our biggest concern was something that was going to change before the actual call, and then we would have to pivot. Nothing's happened. Nothing's changed. So what are we looking at for the rest of the year?
I don't know. I'm just picking it a month out of the blue, but I think probably around October we should know more. I don't see it happening before that. I may be wrong. Yeah,
that's what I've heard. And again, one of our final questions is really around the estimated payments deadlines. And I heard there was talks around when those payments are going to be due, or potential changes to when those payments are going to be due. Can you touch on that?
Yeah, so it's always been weird that the second quarter estimate is due June 15th. Because if you think about it, the first one, the first quarter ends March 31st. The first estimate's due April 15th. The second estimate, which is supposed to be April, May, and June's income, is due on June 15th, before the quarter even ends. There is proposed legislation right now to finally change that to July 15th. So,
which logically just makes sense.
It makes sense, but who knows?
Yeah, who knows? We're not talking.
Who knows if they'll do something that makes sense?
Right, exactly. Well, Michael, we're coming up on our 45 minutes, and I really want to thank everybody on the call for participating today. I hope we kept it a little bit lively. It could get a little boring when you talk taxes, but these are tax changes, and we wanted to keep it high level. And again, if you have any questions at all, please reach out to your contact at Simon Quick or Meisel, Tuteur, and Lewis, and we'll go from there. I would also really like to thank Michael for sharing his expertise with us today. Again, big friend of the firm, and it was a pleasure doing this with him. And who knows, maybe we'll be back for a part two, and we can cover what's actually
hopefully we will in the fall. Yep.
Exactly. So thank you, Michael.
Thank you.
All right, everybody. Have a good rest of the day.